to the cloud. Excellent. Well, good afternoon, everybody. It's officially afternoon. I want to welcome you to the FDU Rothman Institute Friday Zoom at noon program. Today, June 11th, this year is going by so quickly. I'm Dale Caldwell, a professor and executive director of the Rothman Institute of Innovation and Entrepreneurship. We have an amazing group of people. Brian Dettmann, the managing director of mergers and acquisitions at Truist Securities. Erich Holmes, the transition planning strategist, business transition advisory group from Truist Bank. Christina Duffy, who's a friend of the program, a wealth advisor at Truist Wealth Management, and Jonathan Justice, a wealth advisor at Truist Wealth Management, and another friend of the Rothman Institute and our Friday programs. Want to welcome all of you. As always, I'm going to do a little introduction for those that may not know anything about the Rothman Institute. So who are we? Our mission is to support, promote, and research entrepreneurship with a special focus on student, family, veteran, and urban businesses. And we really have expanded over the last year in spite of the pandemic, but it wouldn't have happened without the support of groups like TD Bank Charitable Foundation, Provident Bank, Commerce and Industry Association of New Jersey. Tony Russo may join us a little later, who gives us some great insight into the politics of New Jersey and businesses. One of the things that we're very proud of is starting Family Business Week, and you can find more info about familybusinessweek.com. It's the fourth week in October every year, the same time as our Family Business Awards, which I'll talk about. And what we're trying to do is encourage people to buy and support family businesses during that week, but really throughout the year. And Maura Panuski and Sue Slavin and I, the Rothman team, are coming up. We'll give you some forewarning of a contest to have people videotape themselves spending money only on family businesses that for a day or a week, to really see if they can do that in New Jersey. Next is we talk about, I have a TV show. It's called Family Business World, another one called Entrepreneur State of Mind. It's through Roku TV and rvntv.tv. And what we're doing is really interviewing family businesses and really celebrating family businesses and celebrating folks who advise family businesses on the Family Business World, on the Entrepreneur State of Mind, really talking to entrepreneurs of all ilks to talk about how they've succeeded, what some of their strategies are. And it really has been very, very well received. Actually, I'm excited. On Monday, I'm going to be on the boardwalk in Seaside Heights, interviewing businesses, entrepreneur for the Entrepreneur State of Mind show and Family Business World show. And so it should be a lot of fun, hoping the weather will hold up for us. Next, one of the programs that we're most proud of is our Veterans Launching Ventures program, which has been around about 12 years, and you can find more info on veteranbusinessworld.com. What we do is we work with veterans or the immediate family members of veterans to help them develop a business plan over 8 weeks. Then afterwards, we continue to consult with them to really help their businesses go from startup to success. And the beauty of Zoom is that we've been able to not only have folks from 25 different states participate, but 3 countries. And I'm proud to say one of the gentlemen who was going to be extraordinarily successful called in from Iraq to participate in our at 2 a.m. to participate in the program. And that's entrepreneurship and dedication. Next, you can find this program and others on our Rothman Institute of Entrepreneurship YouTube channel. So we have over 100 videos that provide a lot of really good information. So I encourage people to find that on YouTube and the channel. Then our Family Business of the Year Awards, where we're accepting applications for family businesses that are extraordinary, especially during the pandemic, who've gone above and beyond. This last year, our winners were for our new family business, Laura Mashtaler from Black Swan Espresso. For the under 10 million in sales, Dennis McCullough of McCullough Contracting. And for over 10 million of sales, Mike Seitel from Norwalt Design. I've had the chance over the last 2 days to spend time with Dennis and Mike, and they have just amazing entrepreneurs. We also are working and started a program called Entrepreneur Zones, and I'm actually chairing a working committee with Tim Sullivan and the New Jersey Economic Development Authority. The governor's office put this in legislation to create entrepreneur zones to really use entrepreneurship to help to revitalize economically challenged communities. And so we're focusing initially on Trenton. We'll be working on some other kind of challenged communities, but it's going very well. And entrepreneurship, we really believe, is the answer. So we've been a leader in thought leadership. We've written actually over 15 articles and ROI and NJ Biz about entrepreneurship. We also are really advancing this concept that we call coach leadership. And the idea is, no matter what size business you're in, that it's all about, one, understanding your influences and understanding the influences of others, and really developing them as if you're a coach. The command and control style of years gone by doesn't work anymore. We really have to coach and develop folks going forward. So we're really kind of beginning to brand that and do more around that. And so when you begin to think about the influences, not just of you, but of your employees, and really coach around that, you can become very, very successful. So with that, I want to turn it over to our illustrious guest, and I'm really looking forward to learning today. So Jonathan, I'll turn it over to you to put up the slides.
All right, great, Dale. While I'm doing that, I think Christina's going to give us a little introduction. I'll do the tech in the background.
Yeah, Christina.
Great.
Yep.
Thanks for having us. Really appreciate your time today, and we're excited about this conversation. As Dale said, on the call are my colleagues, Erich Holmes, Brian Dettmann, and my partner, Jonathan Justice. Jonathan and I co-manage a wealth management practice for Truist based out of our Manhattan office, but we serve clients all along the East Coast. In addition to helping clients develop investment management, credit, and banking, as well as estate planning strategies, we also work with clients to create new or enhance existing business transition plans. That can be intergenerational, it can be outright sale, or some combination thereof. And when we have those conversations, we engage partners like Brian and Erich to really bring focus to the conversation. Brian is a managing director, as Dale was saying, in our mergers and acquisitions group for Truist Securities. He has 25 years plus experience advising, operating, and investing in middle market and family-owned businesses. What I think is really interesting about Brian is that he's been on both sides of the table. So I think he understands the mind of the owner as he's been through it himself, and he understands the banking aspect. Erich is a transition planning strategist with our business transition advisory group. His sole focus is to guide clients through the different stages of the transition process. He helps them identify their goals, understand the impact of the decisions that they're making, and helps them execute on those plans in tandem with their outside advisors. So today, our objective is to give you an update on the M&A market, to chat a little bit about potential tax changes that we see ahead, and then offer some guidance on considerations that if you're an owner, maybe you should be contemplating. So I'm going to turn the floor over to Brian and Erich to start the conversation.
Sure. Thanks, Christina. And if you could probably slide up to page 4, Jonathan. Be great. So thanks everybody for joining us today. This is this slide really is an overview of kind of what we see in the middle market M&A environment today. And we've designed this really to focus more on private companies, again, family-owned, entrepreneur-owned companies in what we describe as the middle market. And we kind of look at this is sort of our traffic light summary that we use. And you'll see that we've got 4 greens and a yellow. And there are kind of 4 buckets we've historically tracked. One is around business confidence. That's a little more of a subjective measurement that we do. Valuations, which is a little more objective. Liquidity, and this is around capital that's available. That's something we can measure more specifically. And then financing markets, and that's really around kind of debt and equity capital available. We've added a 5th actually, and this is really kind of consolidation and transition trends. And I'll get back to that too. That's a little bit from our conversations with our clients and kind of how we're trying to keep our finger on the pulse. So again, a mixture of kind of, I'll call it objective measures and also more subjective from our conversations. If we had been having this discussion, a little over a year ago, a year and a half, maybe right before the pandemic, these would have all been green, and maybe at least as green as they are today, including the confidence level. If you think about it, it feels like we're at a really interesting inflection point, as we are hopefully nearing the end of this and coming out of it, as we're feeling like we're starting to get back to normal. People are traveling. People are feeling like we're getting there, at least in the U.S. anyway. So I want to just touch on a couple of these. Business confidence there are probably two in here that have changed the most in the last 15 to 18 months. Business confidence is probably declined. This survey was taken kind of late Q1, so we'll probably do another one here kind of mid-year. I would expect this will trend back up to green, by the way. But if you looked at this a year ago, these numbers of sort of confidence in revenue growth and the ability to create new jobs, those numbers were probably double. They were kind of 75 and 60, 75%-ish. Those have tailed off, as we were still kind of, 3 months ago in the end was not quite as familiar. And we saw people sort of be a little more cautionary, which is why we moved that to a yellow. I would expect if we took this today and we will kind of update this over the course of the next 30 to 45 days, I think this will go back to a green, which is I think good. Again, it's a subjective measurement. On valuations, we've continued to see record prices, both in the public markets. We've seen multiples continue to escalate, and the private company middle market M&A world, valuations on companies continue to be very, very strong. Part of that is a search for growth. Part of that is hand in glove with the next two columns around liquidity and financing markets. Liquidity continues to be ample. And when I say ample, I'm meaning that we have private equity firms with record amounts of capital to invest. We call that dry powder. And as you might know, most private equity firms have an investment window. Usually it's a 5-year period at the beginning of a fund to invest that money. That the amount of money that is there to be invested is measured in trillions of dollars, by the way. And that's just private equity. If we add in their strategics, let's just look at the Fortune 500, the amount of cash sitting on those balance sheets and undrawn lines of credit provide a lot of liquidity to buy companies for growth.
So dry powder, that's the term, Brian. I didn't know that. It's called dry powder. So
I think the origins would go back to, when people carried their gunpowder, right? Lots of gunpowder in their horns or whatever, in the caveman days, or maybe not that long ago. But that's what we refer to that as dry powder. This is capital that is designed, it's been raised to be invested. The private equity firms are charging their limited partners to manage that money, and manage means invest. So there is an impetus to put that money out, right? And that's their job, and they do a fine job of it. And then I put the word accommodative of financing markets up here. And what we've seen, again, the amount of equity capital, some of that's from private equity, from banks, non-bank lenders, the I'll call it the private placement market, the quasi-public markets, and the public markets for debt capital, again, are at probably the most robust I've seen in my career. And when you throw all that together, and I didn't even put low interest rates, you create an environment with a lot of liquidity and an ability to raise valuations. And then kind of our fifth column, which is a newer column we've added to this, is consolidation. And there's a lot of things that we notice differences in attitudes here. Where pre-pandemic, we saw a lot of people say, and I put a quote in here, I'm just going to run this for another good year before I do anything. I'm doing well. The economy is growing. And we're seeing that shift, right? We're seeing that, wow, I survived this pandemic, and survived meaning thrived, or some people barely got by, right? But at the end of the day, and I'm a believer that a lot of family and entrepreneurs make decisions based on events. We saw this in the 08-09 financial crisis, that was more event-driven decision-making. And I think the pandemic, we're starting to see some of that too. That's neither good nor bad. I think, we want to make sure we're objective about decision-making, as we all know, but we're all humans, right? And I think we're seeing this with our clients saying, listen, I'm ready to not go through that again. And something probably will happen. Will it be next year or next decade? I don't know. But I think what we're learning here is that events happen, right? For lack of a better description. And then Erich's going to talk a little bit about this. We also have a lot of uncertainty around tax policy. right? We had a change in Washington, lots of discussion about it. I don't think anyone knows exactly where we're going to end up, and Erich's going to talk about this in a bit. But we know that uncertainty creates, concern, and again, people saying, "Wow, I maybe need to think about my time horizon here, in having a lot of my assets, like a lot of our private business owner clients have a lot of their assets, their net worth tied up in a single asset, the family business." But maybe we'll switch to the next slide here.
This is great. This is really, really helpful.
And here this is, I wouldn't focus too much on any of these, but this is the top part of this is really around kind of volume of deal activity, both in dollars and number of transactions. You can see it tailed off a little bit in early 2020. We picked up in a very strong Q4. We are already seeing that into 21, these numbers will get higher. And again, barring something devastating happening here, we think that 21 will be a record year in terms of a private company middle market M&A. If you look at the kind of mid section on the left, unfortunately the timing, it goes right to left instead of left to right, 18, 19, 20. That's really the funds raised by private equity firms in the last 3 years. And if you look at that, it sort of disguises it. Adds up to about 800 billion. Well, 800 billion is starting to feel a lot like a trillion, right? That's pretty close. And those are big numbers when you think about it. And that's just raised in the last 3 years. There are funds that still haven't invested from the money raised in the 3 and 4 years before that. So there is a lot of, Dale, as we talk, dry powder sitting there to be invested. And again, this is real focused on private equity. This kind of puts venture in a whole separate category, right? So that's different from what we think of as buyout investing.
Brian, can I ask you, let me ask you.
Sure.
So we do coaching with our family businesses. So I had a coaching session this morning, and one of the manufacturers was talking about the price of steel going up, lumber going up. There are no computer chips, so things. Does this impact in a positive or negative way the M&A market?
Well, it's interesting. I think I read somewhere that lumber is up 300%.
He said, yeah.
I did check the price on hot rolled steel. That's maybe double, a little more than double, kind of where it used to always trade in the old days, a couple of years ago. So what does that do? It generally, bigger numbers translate into bigger profit, right? Again, even if you're in the distribution business, if you're doing even a modest margin on a bigger number, you generally will create more profit. We would hope that would translate into higher valuations, right? If you're using even a constant multiple times a bigger profit number should get you higher valuation. That's not always the case, right? Those inflationary costs work a couple of different ways. Some people benefit, right? In if you're not taking a lot of that risk. Other folks, it's their cost they can't pass along, so it starts to erode their profit. Or worse, if you can't deliver your product because you're missing critical components, right? We're seeing this I think I read that some of the car manufacturers are having trouble delivering pickups and trucks and different things because they can't get certain chips. Well, that not only affects those OEMs, the big car and auto companies, but also the people that think about upfitters and people that are building specialized trucks. If they can't get those chassis and those core pieces, they can't build their products. So it does trickle down through the food chain, if you will. So that would work against valuations. And we saw this a little bit through COVID, right? There are some clients or some companies benefited from COVID. Some were sort of neutral, and some were devastated by COVID. So, that didn't always, that somewhat defied rhyme and reason sometimes. I mean, we had clients in the quick serve restaurant business. If you had a drive-through, you set record sales. If you didn't have a drive-through, you were shut down. Same restaurant, same brand, same franchise. So think about, we wouldn't have thought about that a year and a half or 2 years ago, right? Those are some nuances that we saw. And so that does affect value, right? And again, not always intuitively obvious. And then at the bottom here, these are really kind of transaction multiples. And you'll see that if you look kind of the last 3 years on this scale, we were running pretty hard into 18. And 19, you might, that sort of surprised me when I saw that tick down a little bit. But if you recall, I think people were starting to feel like we were late in a cycle, right? You think about we're kind of 10 or 11 years, and there's that human nature to say, well, this can't go on forever, right? And I think people got a little more cautious in what they were willing to pay. You're still looking at a double-digit multiple, so these are not small numbers.
Right.
And then with COVID, actually, we saw things tail off. I think that we will tick up. And the other part that will start to corrupt this data is a multiple of what, right? You'll see companies that had abnormal earnings, either abnormally low or abnormally high during 2020. That will start to, my fear is it will start to make our multiples numbers, less apples to apples in 21, unless we can agree on how we look at those. Right. But that's a quick, I don't want to dive into too much data, but that's what we're seeing out there. And I think the next up here, we're going to move on to kind of some of the tax implications here, what that might affect our owners.
Sure. Yep. Well, I'll take that, and thanks again for allowing me to join you guys today and present on a Friday afternoon. I hope you guys all have a great weekend, and we can get you started off with some cool material here. So I'll talk a little bit about some potential tax changes. The key word in this is going to be potential, because I don't have a crystal ball to know whether or not that any of these changes will happen. There's a lot of dialogue around all of these different items. I'm gonna touch on the ones that are the most recent. But in terms of being in a transaction or thinking about this in terms of transition, Brian had mentioned about, sort of the enterprise value and maximizing enterprise value and where multiples are and the liquidity is today. The second piece of that, what I'll call the second leg of that stool, is really around the net proceeds and sort of figuring out ways to maximize the amount to the family. And one of the biggest pieces that play into that is taxes. And obviously, the Biden administration is looking to increase taxes for what we'll call, some of the higher earners or the higher net worth individuals. So I'll touch on a few of these. The first one that I'll touch on is the top tax bracket is expected to increase from 37 to 39.6% as of January 1, 2022, for years starting after December 31st, 2021. That was a part of the America's Family Plan that Biden put in his proposal. And that's been sort of a consistent theme, and that is actually something that is expected to be increased anyway if no legislation is passed in 2026. So that's one where they're essentially accelerating the 39.6 from being implemented in 2026 to being implemented in 2022. The problem with that one is in 2026, you'll get your reinstated sort of state and local tax deduction that we used to enjoy back before the Tax Cuts and Jobs Act. And that's gone away for a while. And I know, you guys are in New York, New Jersey area, so that's one that's sort of a big ticket item in your minds because New York State taxes has gone up, and New Jersey is on the higher side when you look at the entire country. So that's one that we'll monitor. There was no talks about the state and local tax deduction in the proposal, in Biden's administration proposal, but I expect that to be something that could be on the table in negotiations. The second one I'll touch on in the flow through tax to owner section is this rationalizing the net investment income and the self-employment contribution act taxes. So that's basically this 3.8% tax for net investment income, and then this 3.8% tax for your self-employment income. So as it stands today, some flow through entities like partnerships are taxed on their total operating ordinary income and is subject to self-employment tax. Some are, if you're an S corporation, you're not today subject to that self-employment tax. If you pay yourself a wage, you cover that through your reasonable compensation, and then any additional income that you get on a pass-through, I'll call K1, is not subject to that 3.8% tax as long as you materially participate in the respective business. This rule here is suggesting that they're going to equalize that and say all operating income is going to be subject to the 3.8% tax, whether it's net investment income tax or the self-employment tax. So which is a key sort of provision, and that is expected to come into play in 2022 as well. Corporate tax rates increased from 21% to 28% for years after December 31st, 2021. I think there's been some dialogue around going 21 to 25, but I think this one is one that will increase. We just don't know what the rate's going to be. So it may be 21 to 25, it may be 21 to 28. So
Erich, let me ask you on that. You know, we often see that, and so does that disproportionately hurt small businesses, or is it level playing field? You know, what's the impact on small family businesses of that rate increase?
Yeah, so good question. So when you think about the corporate tax rate, most large public companies, or I would say all large public companies, are C corporations.
Right.
Most small businesses are flow-through entities,
right,
or they're sole proprietors, right? So the corporate tax rate generally will not impact them unless they are a C corporation.
Right.
So,
okay.
But that could be a conversation. So I like to call this sort of choice of entity considerations and planning. So as you're seeing sort of the movement with flow-through income tax, it may make sense for you to revisit your entity structure to see if a C corporation may be the best entity for your respective business and your respective personal ownership. There's a lot of things that go into play on that, but it's something to consider and have a discussion about with your advisors.
Erich, that's a real important point for this audience in particular, because again, I've had my own consulting firm for years, and I assume, well, what was great then, it must be great now. It's not the case. So you really need to talk to your tax expert just to revisit what's going on, because things are changing. So that's important. Most people don't even think about that. But I think that's
right.
a really, really good point.
Yep. Yeah. And it's all around sort of your goals and objectives. And we'll talk through that on owner considerations here in a moment as well. All right, so the big one, capital gain tax rate. So this one is getting a lot of attention. So that this increase from 20% to 37% for individuals with $1 million in adjusted gross income for 2021, and then an increase to 39.6% in years after 2021. In 2021, the effective date being what they described as the date of announcement, which is unclear what the date of announcement is, but we're expecting that to mean April 28th, when Biden first announced the plan, or it could mean May 28th when the actual Green Book, Treasury Green Book came out, explaining some of these details. So we'll see what they mean by that. I think they may have announced and say, well, we really meant April 28th. But again, this is all sort of preliminary. So, but the big thing with this one in the context of transitions is really if you're contemplating selling your business in 2021 and you're selling it for a gain north of $1 million, which is not uncommon, that tax rate essentially doubles. So what that means is if you owned a business that was worth $100 and you sold it today under current laws, then your tax rate is 20%. You would have to, if you wanted to sell that business 1 year later, you would have to increase the value of that business to about $132 or $133. So like a 33 to 35% increase in value in order for you to break even.
Wow.
So it's a big deal if you have a transaction or thinking about a transition over the next year or so, then you may want to figure out a way to accelerate that, especially in an environment where Brian described all of the things are sort of in your favor in terms of liquidity, interest rates, valuations, etc.
Wow.
Hey, Erich, can I ask you a question?
Sure.
Is this an all or nothing situation? Do you think that this is either it's going from 20 to 37, or is it possible there's something in between?
Yeah, that's a good question. I wouldn't know. I think that if it passed, it's likely to be tied to the highest tax rate, right? So it'd say or capital gain north of $1 million, or if you have adjusted gross income of north of $1 million, then your tax is going to be the highest tax bracket for ordinary, for individual taxpayers or married, filing joint, etc. So I think it's likely to be tied to the 37 or the 39.6%. But again, I think there's likely some negotiation room as well in these provisions, especially that you have senators on the Democratic side who necessarily aren't in favor of this change. And they need all of the votes. So I assume that there's probably some wiggle room, but again, no crystal ball here to be able to answer that question. So, yep. So, okay, and then the last one on the capital gains side I'll mention is treating the transfers of appreciated properties by gift or on death as a realization event. So that means if you gift marketable securities of, let's say, $10 million and your cost basis is $3 million, then when that gift happens, there's a $7 million capital gain that you have to pay tax on there, and at whatever the respective tax rates are at the time, right? So you didn't have sort of a liquidity event, but you have a tax consequence on the gift. And so that's a shift that we weren't expecting. That's something that is scheduled to, in the proposal, is scheduled to happen after 2021, which is good. So that gives people some time to plan. If they were thinking about doing gifts anyway,
Right.
then 2021 may be the time to do that. There are many sort of exclusions in this section here. The first is there's $1 million exclusion. So if you had a appreciated property that was less than $1 million, then you don't have to worry about it. If you transfer to your spouse or to charity, you don't have to realize an event. And if you transfer to, this is the one that I think is very unclear, but to a family-owned and operated business, then you can defer the gain until the actual transaction happens. We don't know what the definition of a family-owned and operated business is in the context of this proposal. It's unclear. I think there's been some legislation around special use valuation. So like think of like farms or businesses tied to that sort of type of entity. But it could be a broader definition to include all family-owned and operated businesses. And then you got to decide, well, what if you have private equity in there? Is it still family-owned and operated? So there's a lot of sort of things that we need to get clarification on under this provision to see how it will be implemented. So that's a more of a stay tuned, but it's out there and relevant. So.
Erich, so did I hear you say, so the transfers of appreciated property to a 501c3 nonprofit will not be an event?
That's correct. Yep.
Really? Well, that could be a boon for nonprofit fundraising.
Yeah, I think so. I mean, if clients, and we see a lot of this, our clients are very charitably inclined, and they will think about ways to structure the deal so that they can take advantage of the income tax deduction, as well as provide benefit to the charity ahead of the transaction and after the transaction. So yeah, we see that a lot. So and I'm sure it could be enhanced if rates are changed the way we described.
Great.
Yep. Thank you. Okay, and the last one I'll just mention here, and we'll keep going here, is on the potential estate tax changes. There is, so in Bernie Sanders, 99.5%, and various other sort of legislation, there is a significant sort of desire to reduce the estate tax exemption from 11.7 million to something less than that. And what we've heard is, 5 million adjusted for inflation or 3.5 million adjusted for inflation. But the context is that we don't know what that's going to be. But if that does change and reduce, what that means is there's more people who didn't have an estate tax now fall into an estate tax scenario, and they need to plan for that. So we ask our clients to sort of review that, understand sort of their cash flow needs, and understand sort of what they want or desire to give to their beneficiaries in an effective way where they may still have some sort of control, they may still have some access to the dollars, but they're avoiding or reducing their estate tax. So I'll pause there if you have any questions on that, Dale. But we can move over to why we do what we do.
No, that's great. No, that's great. This is really good information. Tony, did you have Tony Russo is here with you? Tony, any questions? Oh, you're on mute. We can't hear you, Tony. No, still can't. Yeah, and maybe your computer may be off. Okay. Otherwise, it's good. Okay, good. Yeah, go on, Erich.
Okay. So why we do what we do, Brian? I think you wanted to lead this here. I'll chime in on this one.
Sure. No, absolutely. We kind of use this as sort of our voice of the client. And again, we spend a lot of our time talking with our clients with the goal of helping them make better financial decisions around their businesses, around the ownership of their company, what's next. And with that, we listen, right? That's part of our job. And there's some things that come out of that, right? We've as the number here, 77, let's call that 80% of businesses, have experienced a transition event in the last 5 or will in the next 5. We've also determined about 80% of our private business owner companies are either owned or effectively controlled by baby boomers, right? So if think about that demographic, the young end of the baby boomer generation is kind of upper 50s, and the older end is far into retirement at this point. So naturally, as we kind of look at this in the next 10 years roughly, and we've came up with 8 here, that most of these businesses are going to transition in one form or another. There's there's sort of an old joke, everybody exits, right? Those are one of the things we can't either by our own control or by somebody else's, right? And a transition could come in a lot of different forms, right? It might be to the next generation of the family. It might be to the management team. It might be to a third party. There are lots of different ways this can happen. This ties into the planning work that we try and do to be smart about that, especially when you have now shifting sands around what rules we're going to play by, what tax impact those things have. And then we sort of, add to that stew, if you will, that this level of activity, right? We've seen valuations increase. We've seen private equity firms in particular become more, I'll call them marketing centric. And what I mean by that is there's a lot more outreach, right? We most of our clients we've talked to that once a week or more, they're getting some kind of inbound inquiry, whether it's phone call, snail mail, email, something that sometimes more, someone expressing interest in buying their business, someone expressing interest in helping them sell their business. There's a lot more activity today than there was even 10 or 15, certainly 20 years ago in that department. Almost 100% of our private business owner clients have received at least one offer, and many more than that. Written an offer from someone, sometimes with not much work, so maybe that offer isn't really an offer, but it tells you that our clients are being reminded that their companies have value, that there is an opportunity to do something. We hope that we have an ability to help them. And again, there's given kind of where we are, I don't want to call it end of life, but we have a high proportion of private businesses will transition. So what does that mean? That means that there's a premium on being prepared for that. When we surveyed our clients, most spent about a year, 1.3 years preparing and planning for that. And while on one hand, that's great, that's 12, 15 months of time. The reality is that when we surveyed folks, they said the number one thing they regret is not planning enough. And if you think about that, this is something that should be measured in multiple years, right? If you think about, not that public companies are all perfect, but the way they think about succession and transition planning, it's such that, whether it's a CEO, a CFO, if that person leaves for whatever reason, the company marches on, right, and continues to perform. And not that all private companies can afford to or need to be at that level, but it is I think of it as sort of a standard. You should, my conversation with our business owner clients is the first job should be to make yourself obsolete, right? If you think about it, and I say that sort of as a joke, but if you can, be gone for 6 months and your company runs fine, I call that success, right? You've been able to build a self-sustaining company that will have a higher likelihood of successful transition. That just doesn't happen on its own, right? It takes a lot of thought. It takes some expense, right? It takes some planning, but it is and it's easy to say, but hard to do. And that's right. Consistent with what we see too. So I may pause there, Dale. Looks like you had a question.
No, I just wanted to, obviously we work with family businesses. So the challenge with family businesses is that they put their heart and soul in this business. And that kind of planning is almost like buying a burial plot.
Yes.
It's as difficult as that to say, this has been my life. And so, I think sometimes, the corporate stuff don't understand. And so but we try to push them and say, hey, you've got to do that for the sustainability of your business. But it is a tough discussion, but more and more folks have to do it. But your point is well taken. It's right on target.
I think I think we're getting better about this. And I say we, I mean, all of us, in that folks used to be, and we still have a lot of clients who are concerned that, gee, I don't want to talk about transition because I don't want to send the signal I'm leaving or I'm retiring or there's going to be a new owner. I don't want people to worry about losing their jobs. In some ways, transition should create job opportunities, right? For all of the folks that are not, not owners of the business, right? There's an opportunity for someone to move up the ladder into a higher management position. There's an opportunity to take more responsibility. So I think there's some things that we continue to work with about how we can present those as opportunities for the employees, right, of the company, rather than something to be afraid of. Again, easy to say, hard to do.
Yeah, no, I 100% agree, Brian. I think the reality is transition planning is just good business strategy, right? You want to be able to transfer that intellectual capital to the next generation, or the next sort of management team that's going to be taken over for the business. So it's just a part of the deal that makes the company valuable, and then allows you to sort of, you know, better understand what your goals and objectives are in terms of, hey, I'm running this business. I've been spending, you know, 40, 50 hours, maybe 60, 70 hours a week in this business. But is that, you know, what I want to do for the rest of my life? What else am I passionate about? What else can I do that I can enjoy with my family, or I can, you know, do things that, you know, maybe more relaxation, or leisure, or, you know, or just community service, or what have you. So there's plenty of things to do, but the reality is it's just good business strategy at the end of the day.
But I think Dale touched on something that we kind of let go, is that with many privately owned businesses, large and small, the defining line between the individual or the family and the company sometimes is very blurry, right? Yeah. And partly that's what contributed to its success. Yeah. And now you're talking about the reason this is so challenging, right? If it were just the business, it's still hard, but that's more academic, right? You can sort of figure that out. When it gets personal, it gets a lot muddier, right? And more challenging, and the human element comes into play. And again, it puts more premium on being objective, you know, trying to look at it from someone else's seat and be objective. And that's hard, but it really is required, especially the closer you get to, you want to have as much influence on this. You know, what you don't want is have other people start driving the bus for whatever reason, whether that's just through age and time, or, you know, people get fed up, or people leave, or whatever. You know, I always try and encourage our clients, whether it's an internal transition or an external sale, you should be in the driver's seat, right? But that means you got to take the steering wheel and drive.
Right. Yep. And I actually know a number of 90-year-old CEOs, family business CEOs. Yeah. So that's, but then this is great. I also wanted to, Ron West, who's chair of the Fairleigh Dickinson University Accounting Office, is often on this show. And I know he's loving this. This is something we could take back for our students and really have them understand, because it's real world accounting and real world finance. So thank you both for that. Good. What's next?
So next slide, please.
Yeah. Owner considerations. One more slide, Jonathan. Yep. Okay, good. So what do you do now, I guess, is really the question here, right? And I sort of boil this into what I'll call the 5 keys to a successful transition. And the first is what we talked about, is sort of begin with the end in mind. So what do you want to accomplish? What's most important to you, and how do we align sort of this planning with that, right? And that can be what's important to you as an individual, what's important to your family, what's important to your community, and your team, and sort of figure out, you know, how you prioritize those and how we execute on that strategy. The second thing, obviously, is to begin in advance, right? So 1.3 years, as we showed on the slide previously, is just not enough time. You need more time to be able to implement all of the things that you need to do to accomplish your goals, right? And it's very challenging to try to cram it all in 1.3 years. And then the third thing I would say is building a transition team, right? I can tell you without question, the buyers of your businesses are sophisticated. They have they've probably been through this before. They have representation that's going to be representing them. You want to make sure you have a talented team that's been there before and can advise you and navigate through all of the respective things that you have to do, right, in terms of transitioning from your business.
Right.
And then the fourth thing I would say is alignment of the business and the personal. Too often do I see business owners solely focused on growing the enterprise value, not necessarily focused on maximizing amount to the family, as well as the emotional readiness piece, sort of what are you doing next in the next chapter of your life. So just having that alignment, making sure they're balanced, that the business team understands what is needed for the personal, and that we're sort of serving as a bridge to bridge that gap between the two groups. And then the last thing I would say is we like to use the term plan in the green zone, but be prepared for the red zone. Mm-hmm. And what that means is many businesses, I think the stat that I saw was 50% of all businesses transition for reasons out of their control, whether it's death, disability, divorce, disagreement, or complete burnout. That's going to happen for a large section of businesses. And if you're already prepared in that green zone for those respective scenarios, you can be ready to act in the red zone, right? And the red zone is sort of that, hey, there's a transaction that has to happen, or a transition from one generation that has to happen, but we've done all the work already in the green zone, so we are prepared. So that's kind of how I call those the 5 keys to a successful transition. That's how we look at the world and how we add value to our clients. But Brian, I'll toss over to you. Had any other comments to that?
Sure. No, I think you've summed that up well. Back to kind of the timing and the complexity here. And Erich, one of your colleagues is in your team is famous for saying, to put it in perspective, how do you eat an elephant? And the answer is one bite at a time.
Right.
And the planning and preparation is a little bit like that, right? You can't sit down and do it all in one sitting, right? It is, you start to peel back the onion, you have to involve, in many cases, multiple generations, multiple people of the family, and then including the business. And so that, and you start to uncover things like, wow, I didn't think about that, or I didn't appreciate how that would impact, X, Y, and Z. So it is a more methodical process if you're really going to do this the right way and do what's in the best interest of the family and the ownership group. That would be my summary on here.
Excellent. And we have just a few minutes, and I know Christina and Jonathan, are going to close us out, but I always like to kind of take what's in the news now and throw that out. So obviously, the big discussion of the billionaires not paying any taxes, and what are your thoughts? And the 15% minimum corporate tax that they're talking about around the world. And so any comments on those two items? Because they're on the news now.
Yeah, well, I mean, I can't comment on the global tax. I think you're referring to the discussion or the agreement that they came up to, and then was the G6 or whatever. Yeah. So I mean, I think if there's some sort of alignment amongst the countries or the large countries on what they're expecting all entities to pay in taxes, I think that could be a good thing. But I don't have enough details on that to comment specifically on that. But in terms of billionaires paying taxes, I spent 15 years in public accounting. Most of that time was at Ernst & Young, and we had a lot of wealthy clients. And I can assure you that they paid taxes. It may not have been the same percentages that we're looking at today, but right. They were significant in terms of dollars. Yeah. And so that is actually happening. So that's sort of a misnomer, if you will.
Yeah, good. Thanks. I guess, Jonathan, did you want to close it out?
Yeah, sure, Dale. Thanks so much. I just wanted to thank our colleagues Erich and Brian for coming on today. Brian's a repeat performer here at the Friday Zoom at noon, so thanks, Brian, for coming back again. And Erich, always great to work with you too. We just want to also thank the Rothman Institute and all the members for welcoming us back and allowing us to present material today. If there are any questions in the last few minutes, if they want to pop up in chat, I'm sure Erich and Brian would love to interact a little bit with the audience. And if not, I'm not sure there's I was looking to see if we had a contact sheet here on, I believe we do. I'll put it up. I'm going to put up our contact details right now. And if folks want to reach out individually, they're welcome to do that as well. I'll hand it back over to you, Dale.
Yeah, well, no, good. I was going to ask you about that to make sure that people, because there's so much great information that you've shared today, and it's customized for everybody individually. So in the few minutes that we have left, to give people a chance to write down the phone numbers and email addresses. And what I really appreciate this. I mean, I have always a million questions about this. And so from a small business, family business standpoint, many folks may have an accountant. Some of them don't have a regular account. They go to someone for their taxes. What's your advice in kind of seeking out a financial advisor, an accountant, a professional advisor to help them through the very changing financial landscape? What advice do you have?
Brian, you want to start, or I'll take a stab at it.
Why don't you start and I'll pile on.
Okay. Yeah. Well, so we're obviously in professional services, so we're a little biased in the need for having advisors to help you navigate those decisions. But I think it's important, especially from an accountant and a legal perspective, to have those resources available and identify those folks that you can call your trusted advisors, because they are going to keep you from, getting in trouble with the IRS or getting in trouble from a legal perspective, right? There's things that you just may not be aware of because the complexities of the laws. And if you have those advisors to sort of assist you with understanding of that, it can help you go a long way. And I think the cost or the benefit outweighs the cost substantially. So,
Yeah, the only thing I'd add on there is that you want to make sure that your advisors, whoever you hire, they specialize in what you need. And what I mean by that is you might use the same law firm, but it might be a different partner that specializes in mergers and acquisitions versus someone who handles litigation, right? Those are two very different skill sets. They're both lawyers, but they're very different worlds and different specialties. And there might be another one involved in intellectual property and a different legal expert involved in trust and estate planning. Those are just four very different items, but they're all lawyers. So again, right. And you could make the same case perhaps in the accounting profession or other advisors. Make sure it's someone that's their day job, right?
That's right. Yep.
And finally, obviously this is just, a time of constant change. And so we've had everything from PPP now, we're talking about infrastructure projects, we're talking about, what do you help businesses kind of deal with that landscape to see what they're entitled to from some of the kind of the public, the funds that are flowing from Washington and Trenton?
Yeah. We can definitely help. We have capabilities and resources for the bank that specialize in those things, and our local wealth advisors can get you guys in contact with the respective groups on our corporate banking team that can assist with some of the PPP lending and those needs as well.
And then finally, so the name Truist may not be as familiar to some folks. So you were SunTrust. When did you officially make the change? So people know you've been around a long time.
Yeah. So I believe.
Oh, go ahead.
Oh, go ahead. Go ahead.
So the merger of the two banks occurred about a year and a half ago. I believe it was December 7th.
Okay.
So roughly 18 months ago. And it was the merger of BB&T and SunTrust, and all their respective subsidiaries, the wealth organizations, the investment banking operations, the insurance operations. Now, from a branding, that's at the holding company level, the public company level. From a branding standpoint, we're in the process of rolling that brand out across the various business units. In my business unit, the investment bank, we became Truist Securities, I want to say on August 3rd of last year. So we're coming up on our 1-year anniversary, even though the bank merger is a year and a half. Christina and Jonathan, the wealth organization rebranded under Truist more recently than that.
Yeah, in the wintertime, early 2021. That's right.
Excellent.
And I think the commercial bank is in the process. There's a lot more signs to change there.
Yeah.
Well, this is wonderful. And again, I want to say, Brian, Erich, Christina, Jonathan, just thank you so very much. This has been incredibly informative. I always love it when I learn a lot of stuff as well, and I know our audience did. So thank you very much. Have a wonderful weekend. You now know how to contact them, and take care. And this will be our last session for a while. We're going to start up in the fall because people are busy in the summer, and everybody's anxious to get outside and see family and friends. So we imagine they're going to minimize the Zoom contact over the summer. So take care and have a great weekend.
All right.
Thanks, Dale.
Bye-bye.
Take care.
Bye.